Hi, and welcome to the Stock Scores Market Minutes for September 5th, 2017. This week I want to talk about maximizing trading profits. When working to maximize trading profits, there's really two ways to look at performance. You can optimize your trading rules, and we're going to do that with you in a moment, to maximize the overall profitability, or you can optimize your trading rules to maximize the average profit per trade. Now, if you have limited capital, you should choose the latter, simply because you will trade less using up less capital, and it's important, therefore, to maximize the profit per trade. If you never run out of capital, then simply seek to maximize your overall profitability, which ultimately will mean you take more trades. Now, remember that slippage is an important variable that you need to factor into your optimization. It can eat into profits if you make a lot of trades. Now, let's go into a spreadsheet that I use for optimizing my strategy. This is to optimize a day trading strategy. In this spreadsheet, I have data going back a few months, but we're going to focus just on the last 2 weeks. And you can see that we've got 1 week and 2 week here. We've got a few different rules. I won't tell you what the rules are because that's something that I teach in my Active Trader course. Rule number 1, rule number 2, rule number 3, watch what happens when we change things. This is the profitability for 2 weeks. This is the profitability for 1 week. This is including slippage. This is the number of trades, and this is the average profit per trade and the average profit per trade with slippage. Now, if we lower rule 4 to a 0, you can see that our overall profitability jumped quite a bit. All right, so just changing one variable in the model really jumped the overall profitability. We were, at $10 or $20 here. Now it's at $110 roughly with slippage averaging over 1 week and 2 weeks. Very similar results. Now watch what happens if I add in another rule. And again, I'm not going to tell you what these rules are, but just enjoy the ride, if you will. That basically tripled results. We went from around $100 average per trade to now around $300 average per trade. But notice also that we still have a lot of trades, 71 and 128, and our overall profitability is 20,000 on the 1 week and 43,000 on the 2 week. Now we're going to add in one more rule. I'm going to put a little Y here, which means yes. And that dropped our number of trades to 40 and 67. The total profitability stayed pretty similar, but the average profitability doubled again. In fact, over the 2 week period, it almost tripled, went up to $850 per trade and $663 over 1 week. So again, I'll just reverse those. I'll make this a no, and the overall profitability, which is 57,000 for 1 week, drops to 43,000. If I remove this and make it a no, it drops down to 20,000, and yet you're trading even more times here. Look at this. You're trading 200 times to make 20,000. Again, if I make this a yes and I make this a yes, now I'm making 57,000 on only 67 trades. So not only am I growing the average profit per trade, but I actually grew overall profitability as well. And so I'm able to optimize both measures of performance using this method. All right, well, let's get into this week's analysis. This is the chart of the S&P 500, 30-day, 60-minute chart, and you can see that we rallied here. We are now coming into this resistance zone where I expect we'll get stuck, because if you look at the long-term chart, we're back to the old highs, and therefore expect that the market will stall here next week. I'd love it if it broke through, but that's probably not what will happen, because anytime markets rally into resistance, they usually stall there. They only stall there for a couple of days, but expect that early next week. Of course, no trading on Monday because of the holiday. Onto the Russell 2000. We've seen a little resurgence in the Russell in the last week or two, mostly because of the biotech sector doing better. Still under resistance, but the biotech sector has been performing well, heavily weighted with small cap stocks, which of course is what the IWM measures. And so we hopefully will see a continued resurgence in this area, which is good because there's a lot more trading action when the biotechs are strong. On the Canadian market side, this is the short-term chart. You can see we're still stuck in this cycle of falling tops, so I have to rate this bearish. We are, however, flirting with that downward trend line. You could almost argue that it was broken on Friday morning, or Thursday morning. But I'd like to see a real strong break before I move my bullish or my bearish short-term rating on the TSX. My long-term rating on the TSX is still bearish because we're stuck in this downward sloping channel, but if we can break out of that, we'll up it to neutral, and then we'll see if it can get through that resistance zone at the longer-term highs. Moving on to the TSX Venture, it is trying to break its cycle of falling bottoms by replacing it with, falling tops by replacing it with rising bottoms, and we're starting to get an upward move there. So this is looking more promising. Largely, this move is due to the strength in gold, heavily weighted with gold mining stocks on the TSX Venture, and it seems to be helping this market move higher. It's not really exciting yet, but getting a little bit better as the summer draws to a close. On the Treasury bond market, you can see that we're basically in this upward trend still, upward sloping channel, but we're kind of testing the bottom of that channel. So that could lead to a breakdown through the bottom of the channel. If that breaks down, that means interest rates go up. And so you want to keep a close eye on that chart. US dollar still in its downward trend. You can see it's been getting steeper, going somewhat parabolic to the downside. If it can break to the upside and break that downward trend, we can up it to neutral. But for now, this is a bearish chart. It is at long-term support. You don't see it on this chart, but if you go look at a weekly chart, you will see that the US dollar is at long-term support. So it should bounce here, and I expect it probably will next week. On the gold market, we broke out through resistance, and therefore we have to put a bullish rating on it. Upside is not considerable because that's about where we're going to get stuck. So from a risk reward standpoint, it's not a great trade to go long of gold or gold stocks, but as a swing trade, there's some opportunity there. We have to be pretty nimble because you're probably not going to hold it real long given the limited upside before we hit this resistance zone. And off to oil. Oil is still stuck in its cycle of falling tops, but it is trying to base here as we sort of build some rising bottoms. I think that we need to see a good solid break of the downward trend line before we want to get too excited, but things are starting to look like it could break on the US oil or oil market in general, but it's got some work to do. And fear, look at that. We had lots of fear, lots of fear. That's all North Korea. And then we're almost back to the lows before the fear came. And this happens over and over again with the VIX. We just haven't had that real fear rally like we had in 07, 08, a little bit in 2011. And you're always, in the last number of years, you've been best just to sell into fear. Sell, by that I mean sell the VIX, or buy the market when there's fear, because it's often ended with a continuation of the upward trend. So it's not over yet. We still could bounce back again, but we are getting close to those lows again. All right, so my ratings then: US stocks bullish long-term, neutral short-term, hitting that resistance zone I expect will stall. Canadian stocks bearish on both time frames, but on the verge of breaking that. Gold bullish on both time frames, but upside relatively limited. Oil neutral on both time frames, but one good day for oil could break the negative cycle. The buyers came back to US stocks this week as fear came down, and it seemed like investors were scrambling to get back in the stocks that they sold or cover their shorts. This strength likely stalls next week as we test the highs. Canadian markets due for a catch-up and may break that short-term weakness, but it hasn't happened yet. Oil relatively boring and drifting lower, but on the verge of a break. Gold is surging, as I said, limited upside, and fear is falling. All right, let's take a look at the trade of the week. This time I'm going to highlight a swing trade on Gilead. When I swing trade, I look for something called action candles. It's my own indicator provided to my students in the Active Trader course, and you can see the pink dots. Anywhere you see a pink dot, that's the action candle. What you want to look for are the action candles that come from low volatility. So we had one there and we had one there. Both turned out to be great trades on Gilead. Although it's a higher price stock, it does trade options, so you can benefit from going long the options. But to have that kind of a move in a large cap stock like Gilead, that's a big deal. And it all got telegraphed by this abnormal action that shows up in my action candle indicator back on August 28th. Well, I hope you've liked this week's video. Please like the video, share it with your friends, share it with your enemies, tell anyone you know. Have a great week in the market and trade well.